Hello everyone, welcome to today's US Open Live webinar. It is Tuesday, March 14th, 13:20 GMT. We adjusted the time since time changed over the weekend in the United States in order to continue to start this webinar 10 minutes before Wall Street opens. This is your host, Nikos Zabouras, Senior Market Specialist at FXCM. It has been an eventful few days, mostly around the collapse of the Silicon Valley Bank. This has created a market volatility, fears of spillover, another repricing in expectations around the Fed, and we'll talk about all of that in today's session. And of course, less than an hour ago, we had the latest CPI inflation report from the United States. Before, however, we get into all of that stuff, as always, please read carefully through the disclaimers and the risk warning. Okay, let's go ahead and get started because we have quite a few things to unpack. Before we get into the technicals, of course, any technical analysis requires caution now because of the high impact events we've had. Before we get into the CPI inflation report we had a little bit earlier, let's just start first off with the Silicon Valley Bank. We have already commented on it on other venues, so we won't go into every detail, but we need to say that last week authorities stepped in and closed Silicon Valley Bank, guaranteeing deposits, while the Fed also created a new bank term funding program, BTFP, offering loans up to 1 year in length, banks, saving association, and other such institutions in order to help with liquidity. Now, these actions seem to be quite robust in order to contain the fallout, but it is clear that fear is in the market and no one can rule out a spillover effect into other banks. With regional banks seem to be more vulnerable rather than big banks, and these fears and this closure of the SVB, of the Silicon Valley Bank, has created a reset in expectations around the Fed. Let's remind that last week, in the first half of last week, we had seen expectations going higher after Chair Powell had opened the door to a faster tightening path, but that has pretty much gone out of the window now, and everything is up in the air because of the collapse of SVB and the jobs report of Friday, which was strong overall, but showed a declining, a rise in unemployment and an easing in wage growth. These have lowered expectations. Now, at the time of this podcast, of this webinar, CME's Fed Watch tool was assigning the highest probability at a small 25 basis points hike at the upcoming meeting next week from 0.5% previously, and a terminal rate of 5.25%. Before these events, markets were pricing as high as 5.75% terminal rate. Now, overall, this puts the Fed in a tough situation. It's going to have to consider maybe even pausing. Some expect that maybe even a reversal, a course reversal would be appropriate in order to help with financial stability and not focus so much on inflation for this meeting. Now, today we also got the February CPI report, which came in largely in line with expectations. Headline inflation is to 6% year over year from 6.4% previously. The core also ticked down to 5.5%, both moderated to 2021 levels. A bit of a concern is the core month-over-month reading, which actually accelerates to 0.5% from 0.4% previously. Now, overall, this report, I think, shows that inflation is sticky and more action is needed, but we avoided an upside surprise that could create pressure for a bigger move by the Fed, which would create an even more difficult situation. On the one hand, it needs to consider restraint and tightening, where on the other hand, an even bigger, hotter CPI report would create the need for perhaps more aggressive action. So that's what we have in terms of the latest events. But again, this is still a developing story. The situation seems quite fluid and say malleable, and there has been a reset in expectations around the Fed. So obviously, and we have seen volatility. So obviously, caution is needed here, and anything we talk in terms of technical analysis definitely needs to be seen for what it is. Tech is not the main factor at this stage. Now let's go to EURUSD. So what happened after the SVB news is that EURUSD rallied because lower expectations of the Fed widened again, let's say, the policy differential to the detriment of the greenback. The bear has now re-entered the cloud, and above the 200-period EMA here, it has the potential to push for the upper border at around 1.0810, but again, probably does not inspire confidence for taking out 1.093 as a higher degree of difficulty, definitely. Now, the SVB fallout, however, may also restrain the ECB, and we'll talk about it at our last section of this webinar, because the ECB decides later this week on Thursday. So there is still, and of course, there is always risk aversion, which may weigh on the bear as well. As such, there is a risk of a return below the EMA 200 period here, but closes below this confluence of supports at 1.0451, 1.0430 will need a strong catalyst. In any case, the ECB decision will determine the next leg of the move probably, and overall again, we need to stress how there is high uncertainty and the situation is quite volatile. Now, another beneficiary of these situations as Wall Street opens is gold. The precious metal rallied on the back of the US dollar's demise and risk of inflows, hitting the highest level since early February and runs its third profitable week. This has brought the 2023 highs in the spotlight around this region here, 1,959, but freezing it will be required for taking them out. On the other hand, the move looks overextended, and downward pressure would not be unreasonable. However, a significant change in sentiment would be required for the 200-period EMA to be in danger, and gold looks actually well protected from that point on. You can see here multiple potential support levels. And let's round things off with the Nasdaq. We're already into the session. So Nasdaq 100 actually dropped last week because of the negative headlines, but the action taken by the Fed and other authorities seems quite robust. There was, however, a volatile start to the week, but find support due to the lowered expectations around the Fed's policy path. As such, it tries to take out the 200-period EMA, and this would bring this region here into its crosshair, 12,470, 480. This is the descending trend line from this year's highs. Now, on the other hand, we're not sure how far this thing can actually carry it, and if it can go far above that and challenge 12,900. And in any case, if deposits are secured and the broader spillover is averted, we need to remember that the Silicon Valley Bank, as its name probably suggests, did business mostly with tech startups, and its closure could make financing harder, and already the tech sector was more vulnerable to the current high interest rates environment. So there is still risk for further pressure and lower towards 11,005 to 5, but sustained weakness below that level would need a strong catalyst. And we also need, it's unclear still to say whether this rebound this week is sort of like a dead cat bounce or something more sustainable. Now that's it from the technical analysis, and as always, let's focus on what's ahead. As we said, the main event is the ECB policy decision on Thursday, which will be announced as we will be starting our next US Open. The bank had raised rates by 50 basis points last month and had clearly expressed intention for another such move in the upcoming meeting. And commentary since then has pointed to further tightening past March. However, the SVB collapse may cause it to it will definitely be consideration. I mean, European officials at this stage does not seem to see any contagion to European banks and the European banking system, but still it may cause some concern there, and we'll have to see if the ECB will abide by this stated intention or it would become more conservative. Of course, Ms. Lagarde will be in the spotlight and updated projections as well. And we also need to see if they will be able to offer further guidance. Usually when they have updated projections, European officials tend to be more forthcoming, let's say, about what they expect at the next meeting. But again, the uncertain environment may prevent something like that this time around. Other than that, there are a few other things here and there. Our next meeting, mostly industrial production from China and retail sales from the United States, which are due on Wednesday, whereas on Thursday, the start of the day, New Zealand Q4 GDP and Australia employment will be in the spotlight. So that's it from us. We'll talk again on Thursday. Once again, updated time, 13:20 GMT, so that we can still start 10 minutes before Wall Street open. Thank you for joining.